Hello, Realtor partners and homeowners. I'm Mark Teran, your mortgage man with American Pacific Mortgage. Thank you for taking the time to join me to share this new awesome bridge product that we have to offer you in conjunction with HomeLight. Let's just start from a very high level, what the program is and what benefits it has to realtors and borrowers who want to sell their existing home and buy another. When clients are in this position where they need to buy and sell at the same time, unfortunately, there's not a ton of attractive solutions for them to do that. And virtually nobody wants to sell their house unless they know where they're going to be next. And so with buy before you sell, what APM as the lender is able to do alongside HomeLight is make an all cash offer on the client's departing home. And to be very clear here, HomeLight is not in the business of purchasing homes. They have no desire to buy the house. About 98.99% of the time, HomeLight doesn't actually purchase the borrower's home, but because they get an all cash offer from HomeLight, it unlocks these benefits you see here on the screen. And I'm going to go through all of them from the bottom up. The first one, since you're getting an all cash offer from HomeLight per Fannie and Freddie guidelines, as your loan officer, I can now completely offset the mortgage liability from your debt to income ratios, which is huge when it comes to qualifying. Instead of telling you that you have to sell your house first or put it in the market, I can just get you approved. And now you can much more easily qualify for that new purchase loan. You don't have any liabilities tied to your existing property anymore, so you get approved much easier as it helps make your debt to income ratio lower. Secondly, here going bottom up, HomeLight provides a 0% interest bridge loan, and they can go up to a 70% combined loan to value. Now, that's a soft ceiling. They can actually go sometimes as high as 85, 90% loan to value with a tool that we have here that I'll talk about in a bit. For the basic programming way, just the way it is before looking at anything else, let's say they can go to 70% loan to value, no interest or payments on that bridge loan. As a FYI, HomeLight is the one originating the bridge loan. However, I, as your loan officer, will facilitate the process. And then thirdly, here we have at the top the contingency buster. This is what's really cool because you're getting an all cash offer from HomeLight. And that does not mean that the borrower is actually obligated to sell that house or use the program. Right off the bat, you can get approved for buy before you sell. And you're not obligated to sell your house. You can qualify for the loan, and now you can much more confidently shop for homes and make confident non-contingent offers. It does take about 1 to 2 business days to approve a property for the Home Light program. Once you get that approval, you're in the running to shop for a house very confidently. We do have a sample transaction here that I'm going to go through starting in step one. So some example numbers here, and let's not get too attached in any of these numbers, but let's say a borrower has a departing residence valued at 500,000. In this example, they have a mortgage balance of 250,000. If HomeLight goes up to a 70% combined loan to value in this example, the equity unlock that they can provide will be $100,000. And to be clear about that equity unlock, the way it works, it's not like we're opening a line of credit for the borrower and they're not wiring you $100,000 because they don't want you to go off to Vegas and put it on black or something like that. What HomeLight's going to be telling you is you're approved for $100,000 equity unlock. And they're committed HomeLight is committed to wire this money to the title company the day you close if you end up using the program. That's it. That's step one. Here's your numbers, and you move on to step two. Now you can shop without a home sale contingency attached to your offer. Again, the very cool thing here is that you're not working against any deadlines. You're not working against any pressure to sell your house, but you are very empowered to make a strong offer on a home that you love and that you can do that for as long as you need to. It's also not uncommon for borrowers to have their home already listed. The borrower's home is already listed or they're even already under contract, and they just need to offset that mortgage liability and need some money from their equity to use as their down payment. That happens all the time. This is just a best case scenario where we're getting everything done up front. Step two, they're shopping for a home. Step three is when they actually close on that new home. What happens on the day they close on the new property that they want to buy, that's when HomeLight will wire the $100,000 equity unlock from step one to the title company directly. And in this example, their equity unlock for the down payment was $100,000, meaning the mortgage that they got from me, your loan officer, was $500,000 in this example. And we close escrow on that home. Step four, this is when the HomeLight program starts. It's 120 days that you have to sell your home, and you need to be listed with your realtor within 21 days. The borrower will have 4 months after they close on their new house to sell the departing residence. And about 98.99% of the time, the client is able to do that with the agent of their choosing. We in HomeLight are not inserting an agent into this situation. We actually want you to work with the realtor of your choosing. All that is to say is that HomeLight is not dictating the agent piece at all. The buyer has 120 days to sell with their agent. A vast majority of the time, you're able to do that. And what's going to happen is when they sell that departing residence, they will pay back the equity unlock. In this example, that was $100,000, right, to HomeLight. And in addition, there's a 2.4% program fee. So $100,000 plus 2.4% program fee. And to be clear, that 2.4% is based off the final sales price of the client's home. It's not the amount of the bridge loan, in this example, 100,000. It very rarely happens, but what happens if the client is unable to sell their home within 120 days? In that instance, on day 121, HomeLight will step in and purchase the departing residence. The amount that they purchase it for will always be the sum of the mortgage balance and the equity unlock. If you look at step one, they're going to purchase that departing residence on day 121 for $350,000. That's the $250 loan plus the $100,000 equity unlock. Obviously, that's not market value, and fortunately, that's not where this story ends. All that is going to happen is HomeLight is going to relist with the client's agent. They're not going to bring in their own agent at all. They're going to continue on with who the client wants. The realtor is protected here. The borrower can pick their agent, and if they sell the home for anything above what HomeLight purchased it for, in this example, the $350,000, the upside will always go to the borrower. HomeLight does not keep any of the equity. The market will always dictate how much the home sells for, and the program fee stays at 2.4%, even if HomeLight purchased the home. So also be note here, there's a minimum fee of $9,000. So the program fee is either $9,000 or 2.4% of the ultimate sales price. Properties under $375,000 typically fall subject to the minimum fee. Note The clients are not locked into using the program until they close on the new house. So they have full flexibility. There's no risk in signing any upfront agreements or going to the next step started for funding. But HomeLight typically asks for 2 to 3 weeks to fund, meaning we go from step one, we get our approval. Step two, we're out shopping for homes and go through the process. So let's give them time to do their job. If if you end up selling first, then you're not going to need the home light and you're not on the hook for anything. I had mentioned earlier that home light's soft ceiling for the bridge amount is 70% combined loan to value. You go to the next screen. And that is before looking at any other assets that the borrower might have. So just based on their equity, we can go up to 70% combined loan to value. But sometimes that's not enough. If we unlock, in the example, $100,000, but let's say the client needs $150,000 to be where they want to be, we can look at the assets the borrower has to increase the equity unlock even further, potentially up to 80, 85%, and sometimes even 90%. And that's going to depend on what other assets the clients have. These assets sometimes typically include a 401k, a Roth IRA, or other brokerage accounts. And it's actually fairly flexible. Almost anything will work, except as an example, cryptocurrency. If you got crypto, sorry, you're out of luck. We can't use that. And a cool thing here is you don't have to liquidate any of those assets. All it does is, and it doesn't even change the program fee. And so if you have the assets and you want more equity from HomeLight, 0% interest to increase the loan amount, they're going to need to see some statements and then we can get it done for you. So I'll end up asking you for statements, getting the approval from HomeLight to potentially raise that loan to value even further. HomeLight also has an option if the client doesn't need any equity and they just need a backup offer. Regarding the 2.4% program fee, there's really two main objections that we get. The first one's easy to talk about. It's the worst case scenario. Most realtors want to know, are they protected? Are they going to be kicked off at any point? The answer is no. Even if HomeLight purchased the home, the agent stays on. The commission structure remains the same with whatever they agreed with the customer, the borrower in this case. The borrowers typically want to know, are they at risk of losing any equity in the home if HomeLight purchased the house? Again, the answer is no. If HomeLight purchased the house, they're just going to relist it. And if it sells for anything above what they've purchased it for, the upside always goes to the client as the equity of the borrower is always protected. HomeLight doesn't keep any of it. Neither does APN. The biggest objection, the biggest hurdle we often hear is the 2.4% program fee. And we want to help you frame that a little bit. The best way to frame it is not what is the cost of the program, but what's the cost of not using buy before you sell? Because even if you don't use the program, any alternative still has a cost. And one is this notion that you can make an offer with a home sale contingency, which of course you can. The question is, can the client make a winning offer with the home sale contingency? Because that's most likely the biggest alternative here. Can the client make a winning offer with a home sale contingency tied to the offer? In most markets right now, I'd say the answer to that question is no. And it's worth noting too, you guys probably know better than I do, but every borrower kind of has a stamina bar. If they're looking at homes and making offers, when they're making an offer, they make it because they see themselves in that home. They see themselves inviting friends over, have a, backyard barbecue or after church or whatever it is. They envision themselves living in that house. And if they're making offers and they're constantly getting rejected because of a home sale contingency, well, that stamina bar goes lower and lower until they stop and they're just stuck. We don't want that to happen. So buy before you sell. It helps keep you, the realtor, and the borrower from becoming stuck. Back to the home sale contingency. Can they make an offer, a winning offer with a home sale contingency? Probably not. But even if they can, the question becomes how much more money did they have to throw into that offer in order for it to finally get accepted? 3% above list price, maybe 5% above list price. Okay, let's say they get the offer accepted and they paid 5% above list price, right, to get the seller to allow the contingency. Even when that happens, the next part of that equation is that they still have to sell their departing residents in time to close on the home that they just made this winning offer on. And in order to do that, how do you sell a house quickly? Typically, you need to lower the price or become in really competitive. And so, in order to close on time on the new house, maybe they lower their list price a certain percentage below what they originally wanted to in order to close escrow on the new home. So now they think they're getting out of paying this 2.4% program fee, but really they just paid 5% above list price on the buy side and maybe 5% or more less on the listing price of their home that they're selling when they could have just given themselves the convenience and paid a simple 2.4% program fee using buy before you sell. All that being said, it's not just how much money you can save, it's how much more you can actually make using buy before you sell. If they're able to sell the house after they've moved out of it, meaning they now can clean it, they can stage it, and their kids and pets aren't running around when they're trying to show the property, they're most likely going to sell for more. Even if they're able to sell the house for just 2.5% above what they would have originally listed at, the program has paid for itself. And then lastly here, at the last bullet point, is just the versatility that comes with buy before you sell. Even though most of the clients using this program use it just for a down payment, it's not uncommon for the equity unlock to be used for paying off other debt, to be used to pay closing costs at the closing table for the list preparation to make sure that the departing residence sells for as much as possible. I've even heard of suggestions of using the equity unlock as a closing cost to buy down the interest rate on the new home. Ultimately, what we're trying to do for the borrower is lower their debt to income ratio as much as possible and maximize their home purchasing power. And you can do it. It's not just buy before you sell. It's almost like a it's almost like a loan optimization tool that's being provided. The reality of the situation is it allows people to buy for less and sell for more. So to put numbers into perspective, let's say they get an offer accepted with a home sale contingency and they paid just the asking price to get accepted. Well, that's all fine and dandy, but they have to do that because they had a weaker offer to begin with, right? It's very hard to compete with a contingent offer going in. When you remove a sale contingency, now you've got some negotiating power and you could potentially bid more competitively on the home that you want to buy, maybe 10 or 20,000 below asking, depending on the condition of that home, and still get your offer looked at. You can offset the cost of the program just by buying for less. And when it comes to finally selling your home, if you don't do buy before you sell, you're going to be up against the wall. Agents know they'll often recommend pricing very aggressively without batting an eye right? When you're in a contingent situation. And they know the clients are emotionally bought into the new home that they really want, and they just got to get rid of that old one. Buy before you sell is a way that you don't have to be under that pressure. And if you've already got yourselves into that situation, HomeLight can still step in and save the day. So if you're already under a contingent contract and you just need to remove that to prevent yourself from doing a fire sale, HomeLight can still come in and help alongside, American Pacific Mortgage. We work together as a team. When it comes to selling for more, listing agents want their clients out of the house. If they can get it vacant, they can use the equity to get it prepped and staged. It's going to give them the best chance at selling the home for the most money. From a numbers perspective, if you look at the actual NAR data, homes sell 5 to 10% higher when they're listed that way compared to when there's people living in them. The reasons are twofold. One is showing availability. So let's say you got a client with kids, pets, and a bunch of stuff to have to uproot their lives every time somebody wants to see it. Showing sometimes leads to the limited availability, and the home can't be seen. When it's vacant and prepped, they're going to have the best showing experience because the client doesn't have to clean up their house every time, and it can be seen anytime. Potential buyers could kind of envision themselves living in that house much easier. To sell a house fast and for top dollar, agents know the right way to do it is vacant, prepped, and staged. This provides an opportunity to do that. Even if you don't sell for 5% more, maybe you only sold for 3% more, and you paid 2.4% to do it. You came out net positive in nearly every situation. Buy for less and sell for more. All right, so we've talked a lot about this 2.4% program fee. Wait till I show you this next slide. There is an incredibly new feature that is currently exclusive to American Pacific Mortgage. HomeLight can lower that program fee from 2.4% all the way down to 1.5%, depending on how quickly the borrower can sell the departing residence. It looks like this. After they close using the program on the new property, they have a total of 120 days to sell that home. We've already talked about that. But HomeLight is going to offer variable pricing here depending on how quickly they can get it sold. So if they can sell their departing residents within 30 days, so 30 days or less, the program fee drops from 2.4 to just 1.5%. After 30 days, the program fee will increase by 0.015% all the way up until day 90. From day 90 to day 120 and beyond, the fee is capped at 2.4%. And to give some insight into why HomeLight is doing this, they know clients don't want to pay any fees, and that's natural. HomeLight doesn't want their money sitting out there indefinitely at 0% interest without any payments. They want the borrowers to be able to pay back sooner. Another key point reminder is that there is a minimum fee, and that minimum fee is $9,000. On a standard 2.4% deal, the home would have to sell for less than $375,000 for it to be the $9,000. Another important deal is on any transaction, there's going to be about $1,000 in additional cost that comes out of the final sale proceeds. And it's going to cover the things that HomeLight pays for up front, which is a home inspection, mobile notary, and recording a lien. When it comes to pricing, this variable fee model will help where some clients plan on selling their home within the 30 days. Great. Client puts their money where their mouth is, and HomeLight will do the same. They're offering a solution at a lower cost than any other option out there. Okay, so we just went over the program itself and the fee. In all these situations we talked about, if a borrower just needs the backup offer and they don't need any equity to actually purchase a home, what HomeLight can do in that instance is offer just the backup offer, which also significantly reduces the fee from 2.4% all the way down to 1%. So in this case, we're able to eliminate the debt to income ratio so they can go ahead and close on that new home. We don't have to count it against them in qualifying, right? But they don't need any equity. They just need a backup offer. That reduces the fee down to just 1%. So they're getting a backup offer to make a non-contingent offer and to completely offset their mortgage liability. That's a 1% fee or minimum of 5,000. So it's 1% or 5,000 in that case where you're just using it as a backup offer to eliminate that qualifying mortgage payment. So keep that in mind as well. Let me go to the next slide. Oh, come on, baby. Okay. On my end as your loan officer, I will facilitate your HomeLight submission. I'm going to fill out a questionnaire that I go over with you that takes about 5 minutes or so to complete. They're going to ask who you are, who the real estate agent is, and some information about the departing residents. Once that's completed, we'll get an email receipt asking me to submit and asking me to share a link with you, the borrower, to submit photos of the home. It's like up to 10 different photos. Once those photos are submitted, we need to give HomeLight about a business day. That's how long their approval process takes. And they'll be able to shoot back the approval status of that home, or if they, for some reason, can't approve it. They'll also share what the numbers look like, how much equity they can unlock for that borrower. And at that point, especially if you're the borrower, hey, we need more money, then HomeLight may ask, hey, what other assets do you have? Send us over some proof and statements, and that's when we'll have the opportunity to potentially increase the equity unlock. As far as how communication works, it's worth noting that HomeLight is not interacting with the borrower. It will go through me as your loan officer, Mark Teran, your mortgage man, until you close on your new home. After you close, HomeLight has a team of listing operations specialists that will work with you and your real estate agent and the borrower closely. HomeLight will follow up every 30, 60, and 90 days. They want to encourage the sooner you can sell that house, the lower they can keep the fee for you, the borrower. All HomeLight is doing is taking on a certain amount of risk to collect a program fee, 2.4% or less if you get it sold quickly at the end of the transaction. To be clear, HomeLight will handle the upfront process and they'll help me as your loan officer to get you through to submission. These are the property requirements. These pertain to the actual departing residents. HomeLight does not care so much what kind of property the client purchases, but they do care about a home that they might have to purchase. I'm not going to go over all of these. You can review this slide. I will highlight some of the ones in bold. Worth noting here, homes that are eligible are single-family homes, townhomes, and condos. The second bullet point, maximum equity unlock, is $2 million. That's $2 million equity unlock and max that they can do with no interest or monthly payments. I don't know where else you're going to find that. They do have a max, or they don't even have a max as far as the property value. They do need the departing residents to have at least one bedroom and a bathroom. With this program, we can do conventional and jumbo loans, but from a very high level, we're not able to do a new purchase loan using VA or FHA. If a client's trying to do buy before you sell, there's also potentially a couple non-QM options may work as well. Non-QM, or we'll just say loans, are a little bit outside of the box. It's still a conventional type loan. All right, on to the next slide. Some frequently asked questions here. Now, let me go back, make sure that you got to see the property requirements. I'm going to leave that up for a second so you can review it, come back to it. All right. Some frequently asked questions. I think we got through most of these. The cost of the program, it's 2.4% of the final sales price, not the bridge amount. There's a minimum fee of $9,000. There's also variable pricing to offset that 2.4%. Common question that they get, is there a home inspection? Yes, there's a home inspection. After the client gets under contract on that new home, HomeLight will get an inspection ordered for them. They'll send a link to me and to you to get it scheduled. HomeLight, will pay for that upfront inspection. Depending on the size of the home, those inspections fees range between $300 and $900. Again, HomeLight pays for that upfront, and they recoup that cost from the final sale when they collect their 2.4% program fee. The backup offer, again, if you forgot, common question that clients typically want to know is, what the backup offer is. It's always just enough to make sure there's no outstanding balances for the client if HomeLight purchased the home, meaning it's just going to be the sum of the mortgage balance and the equity unlock, which takes us to our next question. They always have upside protection. Again, it's a real statistic that only about 1-2% of the time does HomeLight ever end up purchasing the home. Even if they do, the borrower always has upside protection. If HomeLight sells it for anything above what they have purchased it for, that equity goes to the borrower, the client. Lastly, if the borrower doesn't need any equity fronted to them, they just need a backup offer that's a standalone product. In that case, HomeLight can provide a backup offer for just 1% instead of the 2.4% program fee. There's a question about the home inspection, which is a common question and needs to be talked about. The reason for the home inspection is to try and identify any major problems with the house. HomeLight is not worried about the cosmetic issues, right? You can have 30 pages of little nickety-nick items that are cosmetic. They want to make sure the home's not going to have, let's say, a crumbling foundation or structural problems that are going to prevent it from being able to be financed or eventually sold down the line. If there are major problems, they want to address it. And if the client thinks there's going to be major problems, client can do their own home inspection prior to going under contract on the next house. HomeLight can use a copy of those reports. They'll need those reports to be detailed. In that case, just let me know. I'll get it to HomeLight, and they'll show us exactly what's needed on the inspection reports. If there's any doubt that the home is going to have big ticket items, we should do that inspection up front and get that taken care of. We just need to know. Clients should still keep their own inspection, appraisal, and financing contingencies in their purchase offers because that protects them. In the worst case scenario, where HomeLight does an inspection, it turns out the home's falling apart and then they either have required repairs to fix or it's just not going to work well, then they're still protected where they can back out of their purchase contract on that new home and still keep their earnest money. On the home inspection, when you get under contract, let's get that done as soon as possible. We just want to make sure there's no big problems because that is the condition tied to HomeLight's initial approval, is that there's no big problems with the house. Now, if HomeLight does that inspection and the borrower ends up not transacting for any reason, guess what? HomeLight is going to eat that cost too. So it doesn't get dumped on you, the borrower. So there really shouldn't be any trepidation as far as the borrower ordering that inspection as soon as possible, meaning once they've got under contract on the new home. So have certainly we have certainty that we can close and we also are helping the listing agent. Sometimes realtors want to do a pre-listing inspection and they'll do their own anyways. HomeLight can use those reports just fine, but if the realtors want to get a copy of HomeLight's reports, we can provide that as well. Just ask. HomeLight doesn't do it automatically because some people want to know what's wrong with the house and others just don't because then they would be required to disclose. So if you want to use that inspection to help aid when you're actually selling the house, showing prospective buyers that, hey, my house is good to go, then you can. Just ask us for it. I hope you found this information helpful. This is an awesome modern tool that can help both realtors and homeowners be able to maximize the sale of the customer's current home and make non-contingent offers on the new home that they want to buy. Please reach out for any additional assistance. I would love to help you.